Hello, in this short video I'm going to highlight the TBG Mortgage and Investment Calculator. I will briefly explain the layout and its functionality, but let's get started. There are three separate areas of the calculator. The left side, in light yellow, where you'll find the mortgage tools. The right side, in bright yellow, is where you will find the investment tools, and in the bottom in the white is where you will find the payment schedule or amortization schedule. Okay. The calculator itself was built using Microsoft Excel, but will work on either a PC or a Mac. The white cells are where you'll input the data, while the gray cells represent data output based on formulas. These formulas cannot be changed. Also, if you're unsure as to the cell functionality, simply move your cursor over the cell's title and a text box will pop up with information regarding that particular cell. Most of us find that pretty helpful. Okay, first let's get started over on the mortgage side, the left side, where you'll see the following: mortgage information, extra payments, mortgage summary, fixed rate or ARM, we're talking about adjustable rate mortgages there, balance owed, and tax deduction. I think this area of the calculator is pretty self-explanatory, with a couple of possible exceptions of which I would like to point out now. Regarding the extra payments, let's say you wish to accelerate the payoff of a loan by adding $100 each month towards the principal balance, and you would like to make this extra payment on a continuous monthly basis. You would enter 100 in the payment and 1 for the payment interval, which represents monthly. Okay. See how this changes the interest savings and the overall outstanding balance? If I go back to 0, see what happens? Go back up to 200, see what happens. Okay? Also, extra annual payment. If we would like to include an annual lump sum payment each year, say in June after the tax refunds, we might enter, say, 2,500 and 6, which represents the 6th month of the year. These payments are identified in the payment schedule below as well. So we would enter 2,500 for the annual payment, and I want to put it in every June. Okay. Again, the payoff changes, interest savings. If we look at the payment schedule, you'll see where we made $200 a month. We added the $2,500 lump sum. We can go back just to lump sums. Okay, I think that's fairly clear. Okay, now let's go back over to the tax deduction. Let's talk about the tax deduction real quick. This is a useful tool for buy and hold investors. It provides a look at the effective cost of a loan after tax advantages, as it may pertain to your particular investment situation. Okay, so let's say you're in a 28% tax bracket. You had a loan for 6% on a particular property. That effective interest rate might actually be 4.32. Talk to your CPA regarding that. Okay, now let's move over to the right side, the investor side, where we will find cash on cash return, cost of loan, deal or no deal, and a Mayo calculator. The Mayo stands for maximum allowable offer. Okay, but we want to start with the deal or no deal first. And let's make the assumption in this example that you are a fix and flipper. So let's input some data. Let's say someone's offering you a property for $130,000. And you think after the property's fixed up, it's going to be worth $200,000. Or at least this is what they've told you, or you've done your own research. You think the cost of repairs is $25,000. The holding costs might be $10,000. And the cost of the sale, you need a couple of realtors plus the closing costs and such. You think it's at 7%. Okay. The profit potential on this particular deal is going to be $21,000. So you might move forward with that. That's kind of how this one works here. Okay. Let's move down to the Mayo calculator for a moment. Maximum allowable offer again. Let's plug in, because now we're making an offer. We found a property we think it's worth $200,000 after repair. We think the repair cost is 25%, or 25,000, sorry. The cost of the sale is still going to cost you 7%. We think the holding cost is 10,000, and we think that the profit we're chasing on this thing is 20,000. My maximum allowable offer is somewhere between 115 and 131 potentially. Notice the difference between these two formulas. One is based on the anatomy of a deal and the realization that not all investors are created equal. Yes, we'd all love to get the deal at no more than $115,000, but I think I can potentially go as high as $131,000 by understanding the components of that deal. Okay? Let's say, for instance, that I'm a realtor myself, and I'm not going to charge myself the 3%. I can sell my property at 4%. I can go higher. You see the 70% formula doesn't move. The 70% formula, which I think we've all read and heard, is based primarily on 70% of the ARV and the repair costs. These are the only two numbers to affect it. But quite frankly, as I'm going to show here in just a moment, holding costs is another big piece to this puzzle that a lot of folks don't take into account. Let's go up to the cost of the loan for a moment. Okay, the cost of money plays a huge role in the potential acceptance of an offer or whether to turn the offer down. Especially if you're a wholesaler, you understand this early on, that not all your deals fit all your buyers. The wholesaler with the biggest buyers list usually wins. Let's say that you're trying to do this deal here. You've got 130 is the asking, plus 25, you need $155,000. Let's say you go borrow hard money and you're brand new. $155,000 is what you need. And you go to your local hard money person who charges you 4 points and let's say 14% interest. For 6 months to do your first fix and flip, that's $17,000. Plus electric, gas, snow removal, lawn mowing, things like that. I might plug into my holding cost down here, I don't know, 19 to 20,000. Let's just call it 19,000 for a moment. It just blew up that deal. So then you look at it as a new investor and go, well, that's a lousy deal. Okay, so let's say I've done a few fix and flips. I've now managed to raise private money. The private money I raise is at 0 points and 10%. My loan cost me about $8,000, so I'm going to go back to that $10,000 mark. I'll take that deal. Okay, let's look at the cash on cash return for a moment. It's built for landlords primarily. So let's say you find a property that you can purchase for $150,000. It will need $20,000 in repairs, but will be worth about $200,000 upon completion of the repairs. It will then rent for $1,600 per month. Typically, it might look like this. The bank lends an investor 75% of the purchase price. So you would get a new loan for $112,500. Let's say your interest rate is 5.5. It's on a 30-year mortgage, and let's say that January 1, 16 is the start date. Your principal and interest only is $638. Okay, let's say the taxes on this particular property are going to be let's say $1,200, maybe $1,500, and about $1,000 annually in insurance. So roughly speaking, you've got about $850 a month principal, interest, taxes, and insurance payoff. Okay. We said it would rent for $1,600 a month. Back over in the cash on cash. The out-of-pocket expense on this is going to be $37,500. That represents the 25% you had to put down on the original loan, plus $20,000 in repairs, for a grand total of $57,500. So you'd take $57,500 and you'd plug it in there. What we're saying here then is a quick back of the napkin. This is not after all the expenses and your taxes and all that. This is just a quick snapshot, back of the napkin look at a cash on cash return saying, listen, if I put $57,500 into this property, roughly speaking, I'm making 15 to 16% cash on cash return. And it's going to take me a little over 6 years to get my money back. Okay? Okay? That's kind of how the calculator works, and this concludes the tutorial video on the layout and functionality of the TBG Mortgage Investment Calculator.